Hey everyone. The other day I posted a video about the different entrepreneur motivation types. And in response, Shane Johnson asked, well, what about the different investor motivation types? And I thought that was a great idea. So today I'm going to talk about the different kinds of motivations that investors bring to the table and that you're likely to run into while you're out fundraising. Now, let's keep in mind that the vast majority of investors simply want return, right? And they're going to judge whether or not they're going to get the return that they're looking for based on the product that you're selling and a lot of characteristics about themselves. What's their investment thesis? What's their risk profile? What are they looking for competitive advantage? What do they have in their portfolio? And so on, right? So the most of the investors you'll talk to will just be individuals that bring their own biases and needs to the table to look at whether or not your product will satisfy their need. Now that said, just like any product, there are lots of reasons that people buy other than the obvious ones. And a good example of that is a gym membership. We all know lots of people who buy gym memberships for other reasons than they want to get fit, right? And investors sometimes invest for other reasons than they want return. So what are those different broad categories of investor motivations besides return that you're likely to run into while you're out fundraising? The first category I want to talk about is the controller. Now, these people typically want sort of a pay-to-play in order to invest. They'll say, in order for me to write you the check, you have to do this for me. Sometimes the this is use my marketing company, sit in my office space, assign certain intellectual property to me, etc., etc. Now, this is never a good idea because if they're really interested in your success, then they're not going to try and make themselves or other parts of their company and or influence sphere successful based on your work, right? They're going to look for return, obviously, but in this case, it's much more about what you're bringing to their investment sphere rather than what they're bringing to you, right? These are relatively easy to spot because they'll ask for terms up front and require you to pay to play. The second kind of investor is the it's all about me investor. Now these people typically want to invest in your company for reasons that either give them some credibility with their peer group or give them some kind of outsized influence in your future business plans. So they'll want a board seat, for example, when they may not give you enough money to actually justify that. They'll want to be involved even when they're not needed to be involved. They'll want to show up in press releases, etc., because it's really about the notoriety that they gain from investing in you and the ability to control and have an influence on you rather than your success. All right. The third kind is the strategic investor. Now, the strategic investors are typically not going to show up in early stages. They show up in later stages, and they're in it to learn, to see how it goes, to figure out a particular marketplace. And these are typically large companies that have an interest in a market but don't want to dive in themselves. They're typically silent. They're typically good investors, but they're not going to help you other than giving you some money and watching how you do. These are relatively easy to spot because they'll make themselves known. Most strategic investors will say, I'm strategic money, and leave it at that. In the early stages, like I said before, you shouldn't have to worry about this too much, and in later stages, it's not a worry at all. It's actually quite beneficial. Right. Another kind of investor that you'll run into is the stable master. At least I like to call him that. The stable master views angel and seed investing as part of a portfolio plan, and you're just part of spreading the risk around in their portfolio. It doesn't have often a whole lot to do with you, but about the balance that it brings to their entire investment portfolio. Now, all good investors balance their portfolio. All good investors look for different ways to manage the risk that they have in their portfolio. But the stable master is actually not really as interested in your success as much as they are as what you can do for their portfolio. In fact, writing you off might be tax beneficial to them, and they may be investing in you for that reason. These people are relatively easy to spot because they're not all that concerned about your success. They are much more interested in what market you're in or what your particular risk profile is, rather than how do you get to the point where you get 10x their money for them. Again, these are relatively easy to spot because you're simply a diversification play for them, and you'll be able to tell based on the answer or the questions that they're asking you during diligence. The next kind of investor is the true believer. Now, the true believer is interesting because they really believe in the marketplace that you're going after much more than they believe in your company. And in fact, they may have several companies of your flavor addressing the same marketplace you are in their portfolio because they really want to see that accelerate. Now, these are useful investors as cheerleaders, but they're more cheerleading the market than they are cheerleading you, right? And you may fail along the way, and that's okay for them, because if you push the understanding and the learning of the market or the adoption of a particular technology further, that's what they're interested in. Now, the true believer category also lends itself pretty well to momentum investors, and everybody knows what momentum investors are, right? Oh, this is a hot market. I believe this market's going to continue going up. I'm going to invest in these guys. And that's a great strategy that works wonderfully until it doesn't. And whenever it no longer works, then they're no longer interested in you because you're a write-off and they can move on to their next trend market. The true believer is pretty easy to spot because, again, they're much more interested in the market success than they are yours. The next category is the economic development category. Now, you'll run into this oftentimes outside of the major investment hubs, the Silicon Valley, LA, New York, Boston, Austin, Seattle areas, right? You'll run into this wherever there's not already a pretty big entrepreneurial ecosystem. Now, the economic development investor is interested in having you in their portfolio, but they also want you, as kind of a subset of pay to play, to locate in their area, to spend some money in their area, hire employees, locate an office, etc., before they'll write you the check. Now, I have a lot of sympathy for this kind of investor. I think that their motivation is good because they want you to succeed, because if they succeed, if you succeed, their goals succeed as well. There's economic development in their locality. The difficulty is there may not be an ecosystem in their locality that fits your kind of company. So you have to judge this kind of investor against whether or not what they're asking you to do is really good for you. If it is, it's a nice match, but if it's not, and they want you to locate in some place where there's no expertise for you to hire, that's a difficult thing. Right? So, and these are easy to spot because they'll tell you right up front, you're going to have to locate 50% of your employees in my town in order to get this investment. The next kind is the do great good investor. Now, these are different than the true believers. These people typically have a social or future-oriented attitude toward their investing. It's much more about moving the state of the art forward on a particular plane than it is about your individual success. These can be really good investors because they're going to want to see things change for the positive. And they typically have a more people-oriented view of the world. They would like to see you be successful. They would like to see your employees be successful. They would like to see your customers be successful. But their motivation is less about return and more about improving the state of the art. And the state of the art could be government, could be NGO, could be poverty, could be something, right? Whatever it happens to be. So these are nice investors to look for. They're actually quite helpful. They're going to want to see you be successful. But their basic motivation is above and beyond typical return. So in conclusion, you are going to want to select investors that are positive for you. You're going to want to avoid the negative egos. You're going to want to avoid the forced partnerships and the pay-to-play. You're going to want to avoid investors who are going to bring things to the table or require things of you that are unwanted. You are going to want investors who are going to give you appropriate advice, be appropriately involved, introduce you to their network, give you a hand with the functions that you really need, whether it's hiring, sales and marketing, etc. Those are the kind of investors you want. Well, how do you know what their motivation is? Much as it is appropriate for an investor to ask an entrepreneur, why are you doing this? It's also appropriate for an entrepreneur to ask an investor, why are you investing in me? And you should listen very carefully to their answer and make sure that you understand what their motivations are. And make sure that you select investors that are going to be really good for you. Thanks. I hope this was useful. Please contact me and let me know what you think. Very interested in your feedback. And if you thought this was useful, please sign up for membership I'd love to have you as part of the community. I'm looking forward to hearing from you. Thank you again.